So in accounting, we have two different types of methods in order to um, recognize transactions in the books. And that's the cash accounting method and the accrual accounting method. So the cash accounting method and accrual accounting method are methods that are used to recognize or report the revenues and expenses they generate in a business. Now, when it comes to the cash method, it's pretty simple when it comes to figuring out when to report revenue and when to report expenses in the books. So under cash, revenue is recognized when cash is received. Expenses is recognized or are recognized when cash is paid. That's pretty simple when it comes to the cash accounting method. I like that method because it's pretty self-explanatory. Now, when it comes to the accrual method, slightly different here. So under the accrual method, revenue is recognized when earned. So whenever services are provided to a client or a customer, that's when you recognize the revenue, even though cash has not been received yet. Okay, so here I'm going to put on here cash has not yet been received. Then we have expenses. Expenses is recognized when incurred, which means that it's not necessarily not when cash is paid. So for example, with the expenses, whoever works a full-time or part-time job, you notice that the first week and the second week of work that you've done, you haven't received payment yet. So what the company has to do is they have to accrue the expenses in their books, recognizing that there is an expense and also a liability that's sitting in their books. So they have to report that in their books for the work that you've done for the first 2 weeks. In that third week, that's when you may get that cash payment for the work that you performed in the past or in the previous 2 weeks. So that's an example of accruing an expense when cash hasn't been paid out yet. The company has to report the expense in their books because it is an expense. And you did work those days or those weeks that you are owed money for. So that's the difference. So I provided an example here so that I can illustrate the difference between the cash accounting method and accrual accounting method. And this example here is Bob paid a $12,000 premium on a 12-month insurance policy for coverage. Okay, so under the cash accounting method, and we're going to assume that this coverage, this payment was made on January 1st. All right, so under the cash accounting method, I'm going to go ahead and set up the general journal with the date, account description, and debit and credit columns. Okay, so on January 1st, under the cash accounting method, so since payment was made of $12,000 for 12 months, under the cash accounting method, when cash is spent, we're going to recognize the expense that the cash was for. All right, so the account that we're going to credit is going to be cash. Okay, cash is an asset. And we're going to credit that account for $12,000, indicating that it is a decrease in the balance in that account. Why? Because Bob paid $12,000. And that's it. We don't even have to read on. Under the cash accounting method, as soon as cash goes out, that's going to be credited for $12,000 no matter what. Now, since cash went out and it was for something, that something is going to be recorded either as an expense or as an expense, right? So it's going to be just an expense because when cash is spent, the expense is recognized. So the expense is going to go to insurance expense account. And it's going to be for $12,000 in full. That's going to increase the balance in that account because, again, whenever cash goes out, you immediately recognize the expense because cash was spent. So again, when it comes to these two methods, the cash and accrual method, these methods are used to know when to recognize revenue in the books and also expense in the books. So cash is pretty cut and dry. Cash is spent, recognize expenses. Cash received, recognize it as revenue. That's it. Now, when it comes to the accrual method, it is different. Okay. And accrual method, I like to say that this is also like a credit-based method. Credit method. And that's because whenever you do perform services to a client, or you actually sold something to a client or sold something to a customer, you don't necessarily get the cash right off the bat. You don't get it right then and there. The transaction is not settled. Now, under the accrual method, you will report that as revenue if you perform services to someone and later sent them out an invoice. But under the cash method, you're not recognizing revenue at all because you didn't receive the cash yet. Okay. So when it comes to accrual method, I'm going to set up the general journal again. Account. I'll just keep it as account and then debit and credit column. Okay. So under the accrual method, we scroll back up here. Just look at the scenario again. Bob paid a $12,000 premium on a 12-month insurance policy for coverage. So cash is going to be credited no matter what. Well, I forgot the date here, January 1st. Cash is going to be credited for $12,000. Okay, cash went out. That doesn't change, and it decreased the balance in that account. So since this is the accrual method, when it comes to making an advance payment, you're not going to recognize the expense yet because you haven't used up well, in this case, the insurance policy yet. You haven't used it yet on January 1st. So because of that, the debit is going to go to prepaid insurance. So in order for an expense to be, in order for an expense to be recognized, you have to use it up. Something has to already been done that you paid for. Okay, so prepaid insurance is an asset. We're going to debit that account for $12,000. That's going to increase the balance in that account. Okay, so now this is no different than the prepaid expense examples that I just, well, I haven't done the video yet, but it's no difference in prepaid expense, the method to actually expense an account from the asset account into an expense account. So that's going to be shown on another video. All right, so then on January 31st, that's when you use up the insurance coverage. So that's when it expired. And we're going to take the $12,000 divided by 12 months, okay, to get $1,000 of expense that we need to record in the books on a monthly basis. So under the accrual method, we're going to go ahead and credit prepaid insurance, which is an asset, for $1,000. Okay, that's reporting that, well, it's going to decrease the balance in that account, and that's recognizing the usage of coverage of insurance for the month of January. So that coverage has expired, and we're going to move the balance, okay, into the insurance expense account. This is us expensing what was used up. This is why the accrual accounting method states that when to recognize an expense, it has to be incurred. It has to be used. It doesn't necessarily mean that the cash was spent. It has to be used up or incurred. Okay, so just a little recap. Going back up here at the top, the cash and accrual methods are methods to use to determine when to recognize revenue and expense in the company's books. For cash, revenue is recognized when cash is received. Expense is recognized when cash is paid. Pretty simple when it comes to cash. Accrual method is used when revenue is recognized when earned. So whenever you do need to report revenue, you're reporting it because it is earned, not necessarily when the cash has been received. And expenses are recognized when it's incurred, not necessarily when the cash has been paid. Okay, so here's the example for the cash method here. Given this example here, Bob paid a $12,000 premium on a 12-month insurance policy for coverage beginning of January 1st. And this is the only entry that needs to occur because the expense here is recognized due to the cash being spent. And that's it. Pretty simple when it comes to cash. Accrual method is different. So when the cash is spent in advance, you're not recognizing the expense yet because it hasn't occurred yet. You haven't used up that insurance coverage yet. So the initial entry is going to be a credit to cash, of course, because that doesn't change because cash did go out. But the debit is going to go to prepaid insurance. That's an asset because you have the right to use or right to be covered in insurance for the month of, well, for 12 months. So when the end of January occurs, so the end of the month, insurance coverage has expired for 1 month. So take 12,000 divided by 12 months to get your monthly expense of $1,000. So prepaid insurance is going to be credited for 1,000, bringing that balance down, showing that there's 1 month of coverage that occurred, and then that you're going to expense it or move it into the expense account called insurance expense for $1,000. Okay, and that's going to increase the balance in that account. So this is just a brief video in regards to cash versus accrual accounting method.